Somewhere in here is a money mistake that's already cost you real money. You just don't know it yet. A list of things people believe about money that just aren't true. Let's get into it. Getting a raise does not mean your whole paycheck gets taxed more. Only the new money, the part above your old pay, gets taxed at the higher rate. Everything you were already making stays taxed exactly the same as before. Say you were making $50,000 a year and you get bumped up to $55,000. Only that extra $5,000 gets the higher tax rate. The first $50,000 doesn't change at all. Some people have actually turned down raises because they were scared their whole paycheck would suddenly shrink. That might be the single most expensive mistake on this entire list because the fear isn't even real. Keeping a little debt on your credit card does not help your score. It never did. A lot of people think leaving a small balance shows the credit card company you're responsible, like you're proving something. You're not proving anything. Paying it off in full every single month is what actually helps your score. Letting debt sit there and grow just adds interest charges, and that interest is money you're just handing away for absolutely nothing in return. Closing an old credit card does not help your score either. Most people expect the opposite. They think fewer cards means a cleaner, simpler credit picture. It usually hurts instead. When you close a card, you lose part of your total credit limit, but your spending stays the same. That makes it look like you're using way more of your available credit than you actually are. And the card doesn't just disappear from your history the moment you cancel it either. It can still count in your favor on your credit report for up to 10 years after you close it, so the real damage doesn't even show up right away. You don't need a credit card to build credit anymore. That used to be true, but it isn't anymore. Credit builder loans exist now, and they're built specifically to help people build a credit history from nothing. Services that report your on-time rent payments to the credit bureaus can do the same thing. Neither one requires a credit card at all. People just default to credit cards out of habit, because that used to be the only door in. Sticking to a debit card because credit cards are dangerous isn't actually the safer choice. If someone steals your debit card number, they're pulling money straight out of your real bank account, and getting that money back can take days or even weeks while the bank sorts it out. A credit card usually protects you a lot faster and better, and it costs you nothing extra as long as you pay the full balance off every month instead of letting it carry over and rack up interest. Renting is throwing money away is one of the dumbest things people still say, and it gets repeated at every family dinner like it's obvious. A mortgage isn't free savings either. You're paying interest to the bank, property tax to the city, insurance every year, and repairs whenever something breaks, like a busted water heater or a roof that starts leaking. None of that builds you anything extra. It's just a different set of bills wearing a nicer name. Renting gives you the freedom to move for a new job or a cheaper city without selling a house first, and that freedom is worth real money too, even if it never shows up on a bank statement. Getting a big tax refund every spring is not a win, even though it feels like one when that deposit hits your account. It actually means you gave the government extra money out of every paycheck all year long for free, and they're just handing your own money back to you now, months later, on their schedule instead of yours. The bigger that refund check, the more money was quietly missing from your paychecks the whole year without you ever noticing it was gone.
The stock market isn't gambling. People who say that the loudest are usually the same people who've never actually opened an investing account. Gambling is a short bet built so the odds favor the house every single time, no matter how long you play. Investing in the stock market for a long time, spread across lots of different companies, works completely differently. Look at any 20-year stretch of the stock market, even ones that started right before a massive crash, like the one before the Great Depression or the one right before 2008. And nobody who held on for those full 20 years lost money. Not one single time in over 100 years of history. No casino game on earth can say that about itself, and that difference alone should end the comparison for good. Checking your own credit score does not hurt it, no matter how many people still hesitate before opening their banking app to look. There are two different kinds of credit checks. One happens when you check your own score just to see where you stand. The other happens when an actual lender checks your file because you're applying for a loan or a new card. Only that second kind can lower your score even a little. Looking at your own number as many times as you want is completely safe and doesn't cost you a single point. Skipping your 401k match is one of the most expensive mistakes a person can make without ever realizing they made it. Your job might be offering to add extra money on top of whatever you put in yourself, basically free money sitting right there for the taking before that money even gets invested in the stock market to start growing. Turning that down isn't playing it safe with your money, it's just leaving free cash behind, because nobody ever sat down and explained what the word match actually means. Most millionaires didn't come from rich families, and that surprises almost everybody the first time they hear it. Studies looking at wealthy Americans keep finding the same thing over and over. Most millionaires built their own money instead of inheriting a big pile of cash from their parents. The real pattern behind most of them is a normal job, spending less money than they earned, and investing that leftover money for a long time and just leaving it alone to grow. No trust fund did that for them. A boring, repeated habit did. Rushing to pay off a low-interest mortgage isn't always the smart move, even though it feels responsible and satisfying to watch that balance shrink faster. That extra money could sometimes grow faster somewhere else instead, like in an investment account, earning more than the mortgage is even costing you in interest. Sometimes paying off the house early really is the right call for your situation. Sometimes it just feels good in the moment and isn't actually the smartest use of that extra money. You do not need to be rich to start investing, and that excuse doesn't hold up anymore the way it used to. You can buy a tiny slice of a single stock now for just a few dollars, so you never needed a giant pile of cash sitting around just to get started. "I'll start investing once I have more money" isn't really a plan at all. It's just an excuse people repeat to themselves so they don't have to start today. Not all student loans are automatically good debt just because they paid for a college degree. It really depends on what someone studied, where they went to school, and what kind of job is actually waiting for them once they graduate. Treating every single student loan the same way, no matter what it actually paid for, is exactly how people end up stuck owing tens of thousands of dollars with no real way to pay it back down. Budgeting doesn't mean writing down every single dollar you spend for the rest of your life, or tracking every coffee and every gas station stop by hand. That's exactly the kind of budget most people quit within a few weeks because it takes way too much time to keep up with every day. Simple budgets, just splitting your paycheck into a few big categories like bills, savings, and everyday spending, actually work long-term because you're not doing extra paperwork every single night just to stay on track. Social Security was never meant to cover your entire retirement by itself. It was only ever designed to help out, like a safety net, not to carry the full weight of your future all on its own. And pensions, the kind your grandparents might have had, are pretty much gone now for most working people. Counting on Social Security alone to fund your whole retirement is a much bigger risk than most people realize, usually until it's too late to fix it. Keeping your cash stashed at home isn't safer than putting it in a bank, even though holding a stack of bills in your hand can feel more secure. If something goes wrong at your bank, the government protects your account up to $250,000, no questions asked. Cash sitting in a drawer at home is protected by absolutely nothing, and on top of that, it's quietly losing value every single year just sitting there doing nothing for you. You don't have to be rich to need a will. A will lets you choose exactly who raises your kids if something ever happens to you, instead of leaving that decision up to chance. Skip writing one, and a judge ends up making that choice instead, with zero idea what you actually would have wanted for your own kids. It doesn't matter if you have a lot of money or barely any at all. That part of the problem stays exactly the same either way. Co-signing a loan for someone isn't just a small, harmless favor between friends or family. The moment you put your name on that loan, you become just as responsible for paying it back as they are, even though you never asked for the loan yourself. If they miss even a single payment, it hits your credit too, right alongside theirs, whether or not you ever saw a single dollar of what that loan actually paid for. None of this stuff is actually complicated once somebody sits down and explains it clearly. It just never gets explained that way because everyone keeps repeating whatever they heard from someone else instead of ever stopping to check if it's even true.